All right, new all-time highs today in the Dow and the S&P 500. It's kind of brought out the party hats here, getting above 27,000 on the Dow after breaking above 3,000 on the intraday high yesterday on the S&P. So big milestones on the S&P 500. What do the technicals look like? Are we getting to an exhaustion point here? To the point where we expect a V-top to form. What do the technicals tell us? So I'm going to break that down to see if we should start expecting some short-term weakness, or if we should start expecting even more of an intermediate pullback. So we'll take a look at the charts and see what they tell us. We'll take a look at a stock that itself is having a little bit of its own breakout to the upside in this case after being sideways for so long. We'll talk about how to trade it, considering some of the signs it's telling us to trade and some that aren't, and how to select a strategy that makes sense. So let's go ahead and get started. Today is Thursday, July the 11th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first, and you can see the S&P closed up almost to 3,000, just underneath. In fact, it almost got a new high today, got right up to yesterday's high point. And of course, still stayed in the range, so technically, by definition, an inside day today. But you can see, again, this triple-headed monster combination, right, of a rising green line, a dark green shading, and rising market sentiment. That's about as bullish of a long-term trend as we could possibly have right now. So you look for signs that might end, and the sign would be either like the momentum line dropping to an extreme low. It dropped, but it didn't drop to an extreme low below the 5th percentile, so it actually had to be down a little bit further than that red line. And then the near-term line would have to not get above 80, would have to come down without staying above 50 for that 7 to 12 day mark, get down into the lower reversal zone. I mean, all those things would have to happen, and none of those things have happened yet. So we still have a strong bullish trend. Short-term sentiment's improving. Again, the idea is that we will have 7 to 12 day run, pull up far enough above this near-term high, and that we can use it for support on the way back down, right? If that's not necessarily a guarantee of a continuing bullish market, but that would be ideal. That's what's been done so far, right? Every near-term high point has been used for the low point on the pullback. So as of right now, we are just getting above the high point that got up there to 29.95. So we're just a smidgen up above that. But I mean, that's about as good of a bullish pattern as you could possibly get. You look at the Dow Jones Industrial Average, which again is price weighted, right, of 30 stock average, and is price weighted, not cap weighted. So that more expensive stocks have bigger impact. Visa being one of those today. And you can see it's new all-time highs today, closing at a new all-time high above 27,000. Hence the Art Cashin hats, the 27K. You can see the posture remains strongly bullish, rising market sentiment. Near-term line getting into the upper half of the chart. NASDAQ Composite looks similar. The Russell continues really to underperform. But there is a reason for that, and we'll get into sector rotation here in a minute. But the two biggest weightings right now, at least of the last composition, two of the biggest weightings that it has, here let me go to the sector, the 12 grid, there we go, which has the current rankings, the latest rankings, Brandon's sector selector rankings. Two of the biggest weightings it has are in the financial sector, which has been a laggard for the market for most of this time, and then the healthcare sector, which you can see the healthcare sector there up 3%. One of the top performers here recently, it had a really good day today, at least parts of it did today, but still a relatively small return over the past 3 weeks. So, those two are two of the biggest weightings in that sector. Of course, industrial is also another one. You can see it's kind of lagging behind here. In fact, if I show you this chart, which is actually the S&P 500 sector weightings, but if I show you this chart here, again, you can see some of the weaker performances have been industrials, healthcare, and financials. These are three of the bigger weightings in the Russell 2000, and you can see why it would therefore be a laggard. Small caps would be lagging behind. So don't read too much into that, other than it's just a sector rotation, right? That's we don't, the tech S&P 500 is a really tech heavy, communication services heavy average, and you can see even then they're outperforming these three areas: Amazon, Apple, Facebook, all the Google, all of the big heavyweights, Microsoft, all are in these three. They're the biggest cap weighted components of the S&P, and they, like I said, the biggest, not necessarily materials and energy, but these other three are are technically the three biggest sector weightings in the Russell 2000. So there's your underperformance. It's not necessarily a sign of risk appetite, right, that small caps is lagging. We've seen this before when sector rotation has pretty much led to strong gains in the large cap averages, which have different components, different weightings in the sectors. So that's why your Russell 2000 is really struggling to break out. I mean, it still has the rising dark green line and the dark green shading. So, I mean, that's a good combination. Market sentiment's not quite rising yet, but you can see it's basing. It's been right around this 41, 75, 42 level for a while. So we'll see, if we were to break out above here, it will definitely bring that line up, and then you will have all three patterns. So it's not like we're in a bear market. See, there was a time over here. See, the S&P 500 peaked after the Russell 2000 peaked, and the Russell 2000, even on some of the, well, in fact, let me show you the comparison chart here compared to the S&P 500. There we go. So you can see, the S&P 500 took off during this period where the Russell 2000 stayed flat. We were still at these highs. We were well off those highs there. That's the difference. And the Russell 2000 came down to much lower lows, whereas the S&P did not. The S&P came down to equal lows compared to this one. The Russell went down further. The S&P is well up above these highs. The S&P is well above its January highs, and you can see the Russell 2000s is clearly not. So again, that is a reflection simply of sector rotation. The sectors that have the biggest weightings in the Russell just are not performing, right? They're not. And again, this is not a bullish chart. I mean, this is not a bearish chart. This is a chart that reflects that we have been bearish, that we have been volatile over the last 200 days. This is actually a pattern that you would expect to be bullish over the next couple hundred days going forward from here, until you start to see these rise up and these safe havens start to come down. And as a result, financials and industrials, they'll start to move up too, and healthcare, and then you'll start to see small caps outperform again. All right, before we look at some other charts, a reminder, subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your video. Hit that red subscribe button that pops out. There's also a subscribe button down below the video if you're on the YouTube watch page. That will notify you when these videos are posted. Also, click that thumbs up icon that's down below the video too. That tells me that you got something out of the video today and you want us to do the video again tomorrow. So quick way to give us feedback. It's the only way we get your feedback. So click that thumbs up icon if you like us to keep doing these videos. You can do that right now while you're watching. Also, while you're down there, comment, what did you get out of the video tonight? Let us know in the comment section below. Join our Market Outlook email list. There's a link right there on the top right corner of your screen. Click on that link to subscribe to our list. Very easy way to do that. Follow me on Twitter for more content in between videos from day to day. Put more stuff out there today, so make sure you're following me there to get that content. And join our Market Outlook community that we've created on Facebook. All right, also, if you're watching our video here on our blog on our blog at marketscholars.com, just go to marketscholars.com, click blog, and our mega menu up here at the top. We also invite you to join our website. You can click on this image right underneath Join Market Scholars. That takes you there. It's a quick, easy form to fill out. You can do it for free. That allows you to participate in our Market Outlook forum as well as any other content that we put out there for our free subscribers. Our premium subscribers get access to our class forums as well as obviously our classes themselves So there's a little bit more for premium subscribers, but that doesn't mean that you don't get anything for subscribing for free. We also invite you to engage with us on social media. We try to make it very easy for you to do that. Click this heart right here and that like button that will like today's Market Outlook tweet. And same thing on Facebook by clicking this image. Again, the more you engage with us on social media, the more you're telling them that you want Twitter and Facebook and YouTube, for that matter, to keep putting our content in your timelines when we put it out there. That's how they know that you want to see our stuff. So we try to make it easy. You can do that again right now while you're watching the video here. All right, let's get back to the charts and look at the weekly chart, and you can see, we're getting that longer upper shadow on the Heikin-Ashi candle. So that's a very bullish candle. Again, we worry about bearish moves after we've had a transition candle, something like this, or to a bigger extreme, something like this. We don't always have to have one. We kind of got a transition candle there. It was more bearish in transition in early May. So we don't always have to get one. But more often than not, before we get the reversals, we tend to get the candles that have the small bodies, typically in the middle of the range of the previous body's range. See, that one wasn't necessarily, and we didn't get we probably should have gotten a reversal right here, and we didn't get one in March, earlier March, and we continued higher, and that's what led to more of this uncomfortable pullback for a lot of people. So obviously we're not going to get one of those this week, and remains to be seen whether or not we get one next week. Obviously the midpoint, roughly just by eyeballing, is going to be right around 29.65, and we're trading at 29.99. So depending upon how we close the week tomorrow, we're going to be well above the midpoint next week. So very unlikely we'll get that transition candle next week. Not impossible, obviously, but unlikely. So let's take a look at the 3 green arrow charts. And obviously 3 green arrows, MACD, the moving average is rising, we're above it. MACD is above 0, the histogram is above 0, and the stochastics, the buyers are in control. So 2-line versions of both those charts. You can see the MACD is flirting with its moving average. Keep in mind it is at a relatively high level, so we will get pullbacks from these levels. We are easily above the 8-day moving average, so we're not like threatening an intermediate pullback right now. But there will be pullbacks where we do break the 8-day and test the 17-day, and that will bring the momentum down. But the average momentum, this orange line, is strongly positive. So very bullish momentum, and the orange line, which is the 5-day average of the blue here, is in the upper reversal zone too. So we got strong momentum. It's strong. We don't get V tops, is what I'm trying to say. We tend, when you got strong momentum, it's hard to just really tank from here. If anything, we might slow down because of how strong we already are, but that doesn't mean we'll go down. Now let's look at the intraday chart for the S&P. Nice close at the end, a little rally up off of the lows. So you can see the inside day. We stayed below yesterday's high point and easily stayed above yesterday's low point. Trading in the upper half, though, we closed above last week's high. So it's a relatively bullish mark, considering we started the week well below last week's high point, in the middle of last week's range. You can see where this week's Heikin-Ashi Open is, and you remember next week's will probably be right around, this area here is where the Heikin-Ashi Open will be. The 4-week average, the 4-week midpoint, is relatively low too. That's a lot of room to work with before we get really bearish. But that's going to move up, so you can see, depending upon how far we go up to the upside here, the low point is going to move up after today to about 288.5, and then after a week it's going to move up and stay here at 290.5, a little bit below that, 290 and a third. It will be there for a while. So, again, you look at a 15-point range of this high being, or a 5% range of that high. That gives you, as of right now, 15 points. And once the low moves up here, we'll be at about 10 points. So we've got some room to work with to the upside for it to continue higher, just not significantly higher, right? The concern when you have been bullish for a while and you're worried about the reversal, the concern is when this range really tightens up to like less than that 2.5%, halfway of the 5. Right? That's when you start to worry about an imminent break of the 4-week low point, which would lead you to more of an intermediate pullback and not just a near term. See, we can pull down to this midpoint right now, and that would just be a near term pullback like this one was. And that's perfectly fine to get near term pullbacks. It's the bigger intermediate pullbacks where we go down for multiple weeks. Those are the ones that are uncomfortable and usually brings out the bears in the comment section and the and the doom and gloomers on Twitter and all of that. That's those are the ones that bring those kind of people out. I don't expect that anytime soon, though of course anything can happen. But I more likely will use up this space on the near term pullback. And before we break through these lows, which are way down there, and start a more extended intermediate pullback. Of course, let's take a look at the volume and the range today. Very, very light. We kind of pushed up at the end, 50, but we're still under 50 million, and the range was 1.38 points. I mean, that's extremely small range, well below the 52-week the low point of the ATR, the 52-week range for the ATR, and volume at 50 million is also really, really low. So, this are typical summer moves. They're boring, they're grinding. Doesn't mean that you can't make money, as those who attend our my 2 options classes that I teach during the week. Obviously, there's, they can attest, those premium subscribers can attest that you can still make money in days like this, as as our class portfolio has shown. But it's not the typical way. It's not the, hey, let's buy stocks and see if they'll just take off to the upside. We've hit on a few in our portfolio, but the bulk of our trading has been taking advantage of the grind. Volatility is also showing that we're entrenched. See how we're easily now below 90%. We have been, except for Monday, Tuesday, and then Wednesday, going into today and Thursday, and then next tomorrow. I mean, this might be the lowest close that we've had on volatility. Excuse me, let's go to a weekly chart. This might be one of the lowest closes that we've had on volatility since April. And you can see that was the last time we closed the week below 85%. We had a couple of weeks there below 85 before we rallied, but that was, we were flirting with it. See, now we're expecting to get entrenched where we'll stay down below. I mean, it would be unlikely that we would close back above 90 in any successive week here going forward, as we've had, as I've shown you before on this chart. The typical intermediate run lasts 1 to 3 months, which on the Heikin-Ashi candles would be 4 to 13 weeks, and we are right now on 5 weeks, considering that this is the week here that the intermediate line rose above 50, so we're now 5 weeks into this intermediate run. So in summary, the posture is strongly bullish and remains that way. The train has left the station, it's on its way, it's running down the tracks. There's no signs yet that we're going to reverse anytime soon and head back to the station, right? There's no we don't typically V-top when we're up at these levels, unless we get like an exhaustion move, and we've hardly had an exhaustion move to get to these highs. That doesn't mean that we might not get a near-term pullback. That might not mean, here in another few weeks, we might not get more of an extended intermediate pullback. But again, those will be more gradual and not necessarily the big spikes to the downside like we saw like in Christmas time or October of last year, or the January, February of early 2018. So what do you think? Do you agree with that assessment? Do you disagree? There's a link right there popping out in the top right corner of your screen. Click on that link and then vote. Either agree or disagree. If you click disagree, scroll to the comment section below and let us know what you're seeing that would suggest that we should probably be more bearish than we apparently are, based on whatever charts or indicators or whatever that you're seeing that would suggest that. All right, now let's talk about what's driving price action today. And of course, the big news of the day obviously is what the Fed's going to do, and the expectation that they'll cut rates here over the next, at the end of July. If I were just to take a look at just how the market's moved the last 2 days, because it's the Humphrey Hawkins testimony that's really been the big factor for this price movement. Again, you can see, going into today and holding its gains for the day is crude oil, still remaining very strong. Not as big of a gain today, but still holding its gains. You can see agricultural commodities actually went from a loss to having one of the better performances of the day. The dollar stayed bearish. The dollar still remains down here. You can see it right there. In blue, it's still down over here. Small cap stocks still lagging behind. Again, we know why. From a sector rotation standpoint, there's your S&P 500 outperforming, not outperforming emerging markets. The emerging markets kind of giving back some of its gains with the weakness that's getting from weakness in the dollar. Look at the bonds though. Bond yields really taken off the last couple of days. Again, kind of one of those factors of buy the rumor, sell the news, right? Now that the Fed is going to cut rates, more than likely going to cut rates. The market has been pricing that in. In fact, if you take a look at this, is the 10-year Treasury yield relative to the Fed funds futures, and you can see we crossed below zero here in May, and we're still well more than 25 basis points below. I've compared this level here. Let's see if I can get this to be a weekly. There we go. So I've compared this period of time that we're getting now with this cross below zero to what happened in the late 90s, so mid 90s. So 1995, we had a surprise rate hike, right? And the inflation, this inversion hadn't, the 10 minus the Fed funds hadn't dropped below zero yet, but it was dropping pretty sharply. And by the time we had that rate hike to the time that we got the first rate cut in July, we had dropped below zero, just barely, but we had dropped below zero. And then again, you can see by December, when we got the next rate cut, we were back below zero again, and into January when we got the third rate cut. And then after that, we didn't get any more rate cuts until I believe there was one here, a short one, and then eventually back in this area. And you can see there's a zero level right there. So look how far down we got, 1.25 points below, and how long we were. That obviously led to a recession. So this is very similar to that 1995 period where we are now, to the point where the market's saying that we need a rate cut. And we've seen the precedent before to get one when this particular measure gets to this point, this negative inversion. If we take a look here at what happened in 95, so here's 94, and then we got the rate cut in February, a rate hike, the last rate hike, and you can see from that point going forward into the end of the year, and there's a brief bounce in rates right after the first cut, similar to what we're getting now. That little brief bounce in rates, I expect that we'll continue to get. But then by the end of the year, we still came down. So that's, the market's saying, hey, we still need, more. That's too much. We were at 6% at the time, and we're only at 2%. But, keep in mind, moves from 0 to 2, is a much bigger move on bonds than a increase from 4 to 6, right? Or in this case, from 5.6 to 7.6. That 2% from 0 to 2 is a much bigger move based on how bonds work and how they're priced than, again, like I said, that 2% move up there. So we've had a pretty significant move in bond yields, even if they're still at absolute low numbers. But relatively speaking, because of how low the numbers are, those moves tend to be pretty big, pretty wide on bond prices. And so in this case, you can see the yields dropping as much as they are. In this case, 2 percentage points from 7.8 down to 5.8 over the course of a year. We're not going to drop 2 percentage points from 2.5 down to 0.5. We're probably going to drop down to 2 and maybe down to 1.75, maybe 1.5 again, which is where we bottomed out in the past. But even that's not very likely. But you can see the pattern here. If we do follow a similar pattern to what we saw then, we'll get this kind of sell the news, or buy the news, sell the rumor, or buy the rumor, sell the news kind of a thing where the yields bounce into that rate cut and after before they roll back over and continue to the downside. And so, again, that might mean that we'll get a move on yields, probably up, at least the 10-year yield, probably up into maybe this 2.4% area, where there's a, there's a level of resistance support there. The 200-day moving average will probably be down to that point by the time we got to there. So you get above the 50 when you're whether you're looking at a stock or the 10-year like this. When you have a wide gap like that and you break above the 50 or below the 50, you tend to move toward, like in this case right here, you tend to move towards the 200, and eventually you use it for a support or resistance right there. But when it tends to fill in that gap. And so if we do break above this 2.2% and make a run towards that, I'm going to venture to guess the 200 will have fallen by then to around 2.4. There's other technical evidences for a resistance in that area. So that would be kind of the norm. And then you'll probably get a move back towards 2%, maybe a little bit lower. I doubt too much lower. Definitely, I don't think we're getting down to this area again, but probably maybe a little bit below 2% there. Maybe to the point where we diverge, right, with a lower low on the 10-year with a higher low on this PPO, considering how low it already is. Then we'll have more of a bounce in yields going forward from there. But that's my expectation. That's how I expect, if we follow a similar pattern to what we've seen in the past, based on similar FOMC policy, I expect that we'll get a similar move going forward from here into the end of the year. Of course, rising yields is typically bullish for stocks, as you see on all these other periods where yields have risen. Those have been bullish periods for the stock market, and I expect that to be the case here. Of course, whether the U.S. stock market is bullish or international stocks are more bullish is going to depend upon what this does, right? The dollar, which has been really, really flat and not really on much of a trend, at all. It's still very, very noisy. It has been all year long. It's really lacked any kind of sustained trend. After having strong bullish trend here, breaking out of this pattern and having a strong bullish trend over the long term heading into this year, we've been so noisy. The expectation is that considering that we're still in the Fibonacci retracement zone of that big pullback where we had this big bearish trend, I expect that we'll have a big another bearish move down. And that will be a benefit for these international areas which have been struggling and pulling back, as I showed you on Twitter yesterday with this chart right here. You can see, while we've been so bullish, not everything has been. I mean, all these other major, China, these are all ranked by their size of their economy. So China, Japan, Germany, look how far down we are from their January 2018 peaks where everything peaked. We're well above ours, relatively above ours, and they are way below theirs. UK is way below theirs. France, not as much, but still below their January peak. India as well. Italy as well. Brazil, not as far down. Russia, not as far down. Canada, not as far down. But then you get to Korea, which is way down below those highs. All right, now let's take a look. We've already had some of a sector discussion here, but let's pull up. You can see, today we've had a pretty strong performance in industrials and financials. And for small caps to outperform, you're going to start to need to see more of a sustained move in relative strength from these areas that have been so weak. Materials, another one of those areas that have been so weak. Not on this chart, on this chart here. Materials, another one of those areas that have been so weak over the long term. So on the other end of the spectrum, not surprising to see utilities and real estate down at the bottom again. This is not a risk-off pattern to see these interest rate sensitive areas at the bottom, and I would expect that they'll continue to lag behind, and they've got a lot of relative gains to give up. So it's not, this won't be a bad thing. They've been really outperforming, and that's shown up on this relative rotation chart here on this one. Yeah. So you look at XLU relative to SPY down here at the bottom, and you can see we've had some strong relative performance into the end of last year, and a little bit of a pullback here this year, but still relative strength. We got some strong momentum, but that strong momentum got us to a pretty good relative strength before. I don't think it will. I think it's going to really struggle to get up to that high, to a similar high before it starts to pull back. That's on the weekly chart, of course. If you look at the daily chart here, and you can see the relative strength is negative, right? We've had negative momentum. The relative strength on utilities and real estate, here's real estate, has been both pretty darn negative. And look at that pattern up there on XLRE, and you can see not looking, here, let's go to the 12 grid here. There we go. You can see that kind of evening star candlestick pattern here, not necessarily the most bullish pattern for real estate. So, they've got some gains to give up. Staples is also in that area. Staples is the kind of the third rung of safe havens that have done well over the last, relatively speaking, and you'll start to see them. Whoops, right here. You'll start to see them show some relative weakness too. You see its relative strength chart on the daily down into the lower end with negative momentum as well, even though it's actually rising, obviously not rising as much as what we see in these other cyclical areas. So, and they've again have gains to lose. So you start to get really bearish. You start to take off risk when you see these three, and to some extent healthcare as well, down here, and then these cyclical areas, including industrials, up in this area, right where these are. That's when you start to worry about the market's really pulling back and de-risking, and obviously we're not at that point right now. All right, so now let's look at our trade idea of the day, and we'll take a look at Salesforce in this cyclical area, technology related area, and you can see very strong stochastics move. In other words, if you look at what this blue line is telling us, is that we closed today at the high end of its 4-week range, where we haven't been trading at the high end of the 4-week range for quite a while. So big move up today, very bullish, kind of a breakout type move. Not as big, not the 1.5 times the average volume. So that's going to be a factor in what strategy we select ultimately when we trade this. But you can see, you got the dark green shading, and you got a green line on the moving average with rising market sentiment. It's not above 50, but it's rising. So positive sign there. Obviously, that also means most likely that we have 3 green arrows, which we do. You can see the Bollinger Bands from a Bollinger Band perspective. It is getting up through the point of control, which is the biggest volume resistance it has, and pushing up against the upper band, the upper half of the Bollinger Band width. In fact, to the highest level in the upper half of the bandwidth that we've seen in a long time, higher than these 2 points that we had. So that's a good sign. Then you take a look at the DMI for it, and of course you look for the positive to get above 25. The negative is not quite below 20 yet, and that's what you would like to see. So again, another factor. There's your volume down there, almost average, but you can see the pickup that it has. And then let's take a look at the Ichimoku cloud. You can see breaking through the cloud into the upper half. That's a very positive trend reversal type pattern there. So not a good sign from a technical perspective for CRM to make a bullish move to the upside. You can see bouncing off the 200, breaking above the 50, and potentially making a run. So how do we trade this? Well, let's sell the 155 put, and we'll buy the 150. And if I were to analyze this trade, let's get rid of this one here, and set that slice of break even at August expiration, set that onto the chart itself, and let's go to the Bollinger Bands for it. Then you can see, okay, well, we'd have to get back through all that volume that we just crossed up above for us to start even considering a low point, and we'd have to get below this near-term low that we'd have. So we'd have to basically reverse this breakout that we've had and make a move back to the downside for us to have a loss. So nice, good opportunity here. We can manage our risk. It's the return is 127 for 373 of risk. Of course, 127 is all we'd want to lose out of that 373. That would make it easier to overcome with other trades. And we don't have to worry about earnings. Earnings isn't until after the August expiration, as you can see there. So we have an opportunity here. Again, we're not as strongly bullish because we didn't have the spike in volume. So we're not going to look at the long vertical or a long call for that matter. You do have some resistance up here at this 163 level where the top of the value area is. But if it can stay above the point of control now that we're through it, and stay above all this volume that's at and below that point of control, then that's all we need for us. If it makes a move up to 162.5, up to that resistance, and we can get half of the gains quickly, then we'll take half the gains quickly and move on. But if we end up having to wait it out, then we'll wait it out. So that's kind of the measure. Like if you can get in those first week or two, because we do have 36 days left, so we got about 5 weeks. So if we can get that half of the gains in the first couple of weeks, we'll take it, and then we can try to get something else in those other 3 weeks, right? Otherwise, if it's just kind of flat and moving, and we're just making money from time decay, then we'll ride out those other 3 weeks all the way towards closer to that expiration. All right, now you've heard from me, and now I want to hear from you. Use that link popping out in the top right corner of your screen that goes to our Market Outlook forums on marketscholars.com. Open up any new thread there and ask any questions or share any comments you have on what we discussed in tonight's video or anything we didn't discuss that pertains to the topic that you want to continue the conversation with myself as well as other market scholars in those forums. As always, thank you very, very much for watching the video tonight. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment down on the video below. As always, have a great rest of your evening, everybody, and we'll see you all next time.